first key speaker, Shri Amarjeet Singh. Yes, I'm sorry. All right. Sure. So, all right. I would like to invite on stage Professor Charan Singh. Give a give a huge round of applause, audience.
Good morning, everyone. Welcome to our morning session. And I see everybody is fresh, and I can assure you the panel that we have is going to really enlighten us with their thoughts. We have put together for this special session um, a very special panel. Mr. Amarjeet Singh, he's member Securities and Exchange Board of India, and our host will introduce him in a few minutes. And then we have Mr. J.G. Mammon, who is with Sadhan, and he has worked at NABARD Financial Services, and now he heads Sadhan, umbrella body on microfinance institutions. And then we have Professor Surendra Kumar, who's from Delhi School of Economics and will be speaking to us. The concept paper will be shared with Professor Vinayak Deshpande. I just want to introduce you to the subject and bring you as to what this session is all about. In this session, we are going to present to you mainly thoughts on financial inclusion, and the focus is on inclusivity. Now, if you would remember, some of you who are around my age, the banking industry has been chasing this idea of inclusivity since 1950s. The first nationalization that took place of State Bank of India in 1955 was with the very purpose of improving banking penetration in the rural areas. Much had been done by the State Bank of India with its wide network of branches. The second round of nationalization, which came in 1969 for private banks after upon and over a certain threshold, again the focus was penetration in the rural areas. The third round of nationalization happened in 1930, and that exactly was the idea. If you look behind a few years, somewhere around 1905 in India, we started thinking about financial inclusion when the cooperative movement started, and under the cooperative movement, the banking industry played a very important role. Those cooperative institutions continue to function very well even now. They are nearly 1 lakh. The focus on financial inclusion started happening sometimes around 2005-6. At the Reserve Bank of India, a thought started coming up that is everybody having a bank account in the country? The Deputy Governor, Mr. Khan, came out with a report where he suggested to extend financial inclusion, we will need business correspondents. The business correspondent circular of the RBI is way back in 2006. It was then that I was heading a division which wrote the statutory report Trend and Progress of Banking in India. And the governor at that time, Dr. Y.V. Reddy, wanted us to include a chapter on financial inclusion in this statutory report. I had to undertake surveys in Bombay, which I did on weekends on foot, dressed up like a common man and trying to understand what financial inclusion entails, what does it mean, and why people do not have a bank account. So I interviewed the taxi drivers, the auto rickshaw drivers, and the Bombay dabbawalas, the banana sellers, and the head load workers in Crawford Market. After a small survey, which was 80 in number at that point of time, I realized how important this concept is. Dr. Y.V. Reddy, governor, then wanted us to know, has the nationalization resulted in results in terms of yielding bank accounts with people? So an internal committee was set up, and I was the member secretary of that committee, And to our horror, we found only about 35% Indians had a bank account. Let me remind, first nationalization 55, second 69, third 1980, cooperative movement working, and 35% of Indians, mostly in urban areas, and not all people even in urban areas had a bank account. It was a very, very catastrophic report. Buried, obviously. Dr. C. Rangarajan was then drafted to do another study on microfinance in India, and his report is seminal. It is in public domain, 2008, and he came out with the story saying about 50% of Indians have a bank account, and therefore the success has not been much. And he recommended financial inclusion on a mission mode. 2014 onwards, financial inclusion is history. And we all know how, in a single day, under the Jan Dhan mission of the Prime Minister, we achieved record breaking results. Today, under Jan Dhan, we have 51 crore accounts. The journey that happened in bringing people into the inclusivity mode to a great extent was facilitated by the business correspondents. The handheld devices, which were piloted by the State Bank of India, did a wonderful job. They still continue. The business correspondents also continue today. Let me now move into technology and bring you straight into the thoughts which all of us have been worried, and as professors of economics or students of economics, we all know what money is. We all know the functions money does, but we also know the distinction between fiat money and the commodity money. With technology, and yesterday there was a question on blockchain, with technology, the idea then emerged in terms of cryptocurrency. A cryptocurrency is a highly developed technical tool which can be used for currency. But as economists and people working in the public policy area, you would know the distinction between fiat and commodity. The main distinction that is that the fiat money has to be regulated by the jurisdiction of a certain geographical limit. What do you do with cryptocurrency? And so many of us wrote on it, and then the government of India also worked on it. And you must have seen before the last budget, there was lots of discussion on cryptocurrency. Should we do it? And India, the pioneers in thinking as well as technology, then thought about the central bank digital currency to answer the challenges or the opportunities which a cryptocurrency provides. Again, India is on the frontier of knowledge, and we have tested and piloted with the CBDC, and Reserve Bank has done an excellent job in that aspect. The financial world and financial inclusion cannot be complete just by talking about the banking system. NABARD has done an excellent job in bringing people into the fold, starting with the self-help groups. So today we have Shri Gigi Memon, who has started his career in NABARD and moved on to NABARD Financial Services and now Sadhan, and he's going to tell us details about what's the journey up there. SEBI has also played a very important role since its inception as a regulator of the market. And many of us have delved in the stock markets, and the stock market is reaching out to villages and rural areas, providing them opportunities to fund and finance growth and participate in the financial world, participate in the growth story of the country. To talk about the role of SEBI, the regulator of the markets, in financial inclusion, we have none else but the member from SEBI, Mr. Amarjeet Singh, speaking to us today. Finally, Professor Surinder Kumar is going to give us a complete picture of financial inclusion. With this, I complete my introduction, and now I would invite Professor Vinayak Deshpande ji. He is the VC, GH Raisoni University, Amravati, for concept briefing, and then we will move on to Mr. Amarjeet Singh, who will speak to us between 15 and 20 minutes, and then to Gigi Memon for another talk on financial inclusion, the journey of NABARD, another 15-20 minutes. Finally, we'll close the session with Professor Surendra Kumar. Let me invite Professor Vinayak Deshpande ji.
Good morning, everybody. Chairman of this session, Professor Charan Singh, Professor Surendra Kumar, Association President, Professor V.K. Malhotra, Secretary, Professor D.K. Madan, esteemed dignitaries, galaxy of economists, eminent panel. I'm just delighted to be here, and thanks to Indian Economic Association for giving me this opportunity. I'm very proud to be here. Professor Charan Singh has laid broadly the template for today's morning discussion. Friends, in a country of 1.3 billion people, where almost 25% are illiterate and many millions, they don't have access to banking and regulated financial products and services. So financial inclusion not only holds key to empower those who are not having access to any financial institutes, but with access to banking credit availability and regulated investment products. It also holds a key to protect them from unregulated investment products, entities, and harassment from the practices of money lenders. Friends, the country has witnessed significant revolution in the last probably 7 to 8 years on the back of deep penetration of mobile phones and internets. So we have seen financial technology companies launching their services, launching their products of international transactions on mobile phones. And our chairman has rightly pointed out, Janadan. So we have now 51 crores of accounts and more than probably 100,000 crores of balance. UPI transactions, they have also witnessed a significant jump from zero point 0.3 million transactions volume, and now probably it is more than 200 million. Similarly, mobile banking and wallet volume of transactions, they have gone up significantly. Today, we have a very eminent panel to discuss financial inclusion and issues like technological development and performance in financial sector. While all four are from different fields, they are closely involved in all financial related issues. And the focus obviously is on financial inclusion. To be more specific, it is digital financial inclusion, I would say. So there are broadly two steps. First part is what we are more familiar with, having seen, like opening Janadan accounts, Aadhaar India's tag for authentication, and now as we mature, we are looking at the more interesting part of how not just open a bank account, but avail of services, and one indicator of that is payments. So why would people change the way they make payments? At a very high level of operations, people are convinced that it is convenient. For somebody who has nothing to hide, making a payment by sitting at home, online mobile payment, convenient of that is definitely unmatched, but this logic is not enough. All transactions may come open, and there are certain psychological issues, and how to deal with these psychological issues is also the challenge as far as this modern technology is concerned. We consider that it's a cashless world, but we have to think, is it possible that there is going to be cashless world? Probably it is less cash, and less cash doesn't mean cashless, and therefore the number is rising. That itself is quite encouraging for all of us. So digital payment will give you probably better incentives and of course credit, but what is required is the kind of infrastructure. And country like India, the amount of machines having, we can use our debit card or credit cards, they are probably not widespread locations, and therefore that machines also, that number needs to be enhanced. So coverage is low still for the population of the country. Of course we are moving towards QR based payment, card based to mobile and QR based, and there is a potential for universal digital coverage. So financial inclusion, financial education, financial consumer protection, I consider that these are the essential ingredients for financial empowerment. And when we talk about financial inclusion, basically we are finding how we can provide financial access for those, particularly in remote or underserved areas and citizens across the country. So basically, I would say it's a supply side issue when we talk about the word financial inclusion. And when we talk about financial education, how to create demand for such products, that is the challenge. So financial education, that risk nowadays we find it has been transferred to individual and households, and therefore that education is important. So financial products are also becoming very complex. There is rapid technological change, and financial inclusion should come first or financial education should come first. Probably it is like chicken and egg question. So both should go hand in hand. Jam, that is Janadan, Aadhaar, mobile, it has increased potential power of the country, and digital financial education, how to use digital mechanism prudently. And I feel India has made tremendous progress in financial education. It plays a crucial role in addressing different societal issues, including economic growth, employment, poverty mitigation, as well as income equality access, both developed and developing countries. But to measure this financial inclusion, probably we have to focus our attention on three basic indicators. One is access indicator, that is depth of financial institution outreach; usage indicator, how clients use financial services; quality indicator, that is extent to which financial services and products meet clients' needs. And these technological advancements, they offers opportunities, but at the same time poses significant challenges for financial inclusion, and challenges that are mainly related to access, understanding, affordability, security, and trust. So technological advancement can also increase divide between individuals who have access to and are comfortable using digital tools and those who are not. So that is also going to be the division. So last point which I would like to make, cyber security is going to be the biggest challenge, and over the years industry will go a transformation towards a landscape driven by digital advancements. So yesterday we talked about artificial intelligence, machine learning, blockchain. Chairman talked about cloud computing. They are assuming crucial roles, but these advancements probably will empower banks and financial institutes to automate various operations and make many decisions that will be based on data. The point which needs to be considered that banks are one of the most data dense institutions that the public interacts with, and everything from the names of our dependents to our own fingerprints, they are stored connected to an account in order to provide all the convenient services we enjoy. Naturally, this makes banking databases prime targets for hackers with malicious intent. And therefore, these challenges I feel need to be addressed. We have a wonderful panel, and I'm sure that this session will be quite educative for all of us. Thanks to again Indian Economic Association. Thanks to Chair for giving me this opportunity. Thank you so much.
Thank you, Professor Vinay, for that concept. I would now like to invite a member Seth to share his thoughts with us. Amarjit Singh ji. Please unmute, sir. You have to unmute Amarjit ji.
Yeah, sorry about that.
Yes, we can speak now.
Okay. Thank you. Thank you for confirming that. And good morning, everyone. It's a pleasure to join you virtually from Mumbai. I wish I could come in person, but that was not possible due to certain pressing engagements here. In any case, so what I would like to do in the next 15-20 minutes is share my thoughts on, and I'll try to put it in the context of the theme of the panel, and that is technology, performance, and inclusivity in the financial sector. So, what I would like to do is talk about how SEBI is using technology to improve the marketplace for all stakeholders. So, that would be one piece. Second would be what are the key risks arising out of use of technology and how we are dealing with those risks. So, these are two main strands. Thirdly, I would like to digress, and I'm doing it with a purpose. It is a conference of Indian Economic Association, and I believe there are a lot of economists who are attending this. So I would like to digress and talk a little bit about how research can support regulatory decision making, how your work can contribute to what we do in the market. So that will not be exactly technology specific, but I thought I'd take this opportunity since it is a meeting of and a conference of economists. So let me take this opportunity to talk about that in the end. So first, let me come to the main theme, how SEBI is using technology to improve the marketplace for all stakeholders. Just to set the context, and I'm sure many of you would already be aware, first we need to understand what is the mandate of SEBI. So we have a threefold, the mandate, and that is develop, regulate, and protect. So development of the markets, regulation of the markets, and protection of investors' interests. These three objectives are at the core and they guide us whatever we do, whatever measures we take in the markets. So we think, as a part of our mandate, we've been focusing on analyzing more savings into investments to securities market, and there are a lot of ways we do that by we facilitate ease of investing, we try and make markets more safe, we try and make markets more inclusive to achieve this objective. So that's broadly the context. And in the last one decade or so, I would say, I mean, let me also mention that as far as regulation of securities markets has been concerned, uh, technology has been a very, very key factor right from early days. I mean, you have screen-based trading right from mid-90s. You have dematerialization in our markets right from late 1990s. So, it's not it's new for us. There is some disturbance. Am I
We can hear you clearly.
okay, thank you, thank you. A key aspect underpinning all our endeavors, especially in the last, I would say in the last decade, there has been an acceleration in adoption of technology in all the sectors, including security market. And it has presented numerous opportunities for us. And our objective is how we can adopt technology to improve the marketplace for all stakeholders and how also it can help us regulator in better monitoring and better surveillance of the market. Let me give you some examples in terms of how technology has transformed the way markets operate. And let me give you some examples from the recent past. Recently, in the equity market, I'll give you examples from equity markets and also the debt market. In the equity markets, we moved from T plus 2 to T plus 1 settlement. What it means in common language is that once you trade it, you are assured of your payout in terms of securities or on money on T plus 1 basis. And we are one of the first market to use, and this was done to in a very gradual process so that there is no disruption. But we completed the process early this year in January. In the there was a mention of UPI and Aadhaar by the previous speaker, so we use that also in many ways in our markets. The recent use case was now that reduces the listing period to T plus 2 T plus 3. In the debt market, we have electronic bidding platform and we also have request for quote platform. Uh, there is also we are also using distributed ledger technology in the bond markets for monitoring of bond covenants. We also have a committee on financial and regulatory technologies. It is called CFRDE, which advises us on the developments in fintech in the securities market and related opportunities and challenges and how to deal with those. Uh, so the committee has prepared guidelines for the use of ML applications in the markets, and it has also advised on including the use cases of blockchain, DLT technology. As I gave you one example that we are doing successfully in the bond market for the monitoring of bond covenants. And let me also mention, in fact, other jurisdictions have also shown interest in adopting that for monitoring of bond covenants. Let me talk a little bit about how technology has eased interface with stakeholders. Um, right from the point of entry in the market. So we have Aadhaar based like for a mutual fund scheme. So all those entry points have been made more efficient by a very easy onboarding for Aadhaar enabled KYC process. In terms of placing orders, and this is nothing new, you have web-based online trading platforms and now mobile-based applications to facilitate trading. Trading costs have gone down. For investors, we have the Force platform for grievance redressal and a mobile app called Sarthi. In case you want to check, you can check. There is a mobile app called Sarthi for investor education. We also dispute resolution mechanism to expand the conciliation and arbitration processes which are offered by market participants and institutions. For our registered digital interface in the areas of submission of compliance reports and filing of draft schemes and offer documents, etc. Let me now give you a sense of how we use technology to make the markets profit. And this is very important. Technology has helped us mitigate structural risks in our market, such as third-party default risk of misappropriation of client securities, risks in the trading and settlement infrastructure. And a number of recent measures are aimed at mitigating these risks which I just outlined, such as implementing securities posted as collateral, framework for trading supported by locked amount to prevent misuse of client funds, as well like structure for secondary market. So we are working on enabling application of UPI against market, which means when an investor trades, only a block will be created. Only a block will be created on the investor's account, and only after the execution of the trade, funds will be transferred from investor's account directly to the trading corporation, and it will not go through the. So it completely, mitigates the risk of misuse of client money in the hands of intermediaries. And that will happen next year. Then validation of paying. I mean, I don't want to bother you with a lot of technical stuff here, but the short point I'm trying to make is we are using technology to make the markets more safe and more efficient. And I gave you some examples of that. Let me now tell you how we are using technology to improve our regulatory supervision and surveillance. So we've been focusing on a number of analytical tools to assist in monitoring and supervision of the regulated entity and in detection of misconduct. I would say on a real-time basis, on a more proactive basis. So there are a lot of blind spots when we supervise the market. So our attempt is to reduce those blind spots to the minimum possible by use of technology. And just to give you a little more details around that so that you get a flavor of what I'm trying to say, we revamped our approach to supervision of market infrastructure institutions, which is exchanges, depositories, clearing corporations, by integrating technology in the inspection process. Uh, the idea is to automate the inspection process and undertake off-site monitoring of some of the areas of operations of MIS. And there is a paradigm shift here, if I can say. We are transforming what used to be an annual inspection cycle or annual inspection exercise into a toolkit for online supervision on continuous basis. So we are developing required software utilities which will facilitate receipt of information and machine-driven alerts wherever there could be red flags. And it will provide us indications of non-compliance wherever possible. So these utilities will serve as a tool for effective compliance management. We've already started this exercise with stock exchanges, and going forward, similar exercise will be undertaken for depositories and clearing corporations. So the idea is to strengthen the supervision and governance, which serve the role of strengthen the supervision and governance of MIIs, which are public utilities. We've also strengthened the inspection of mutual funds, again by bringing in off-site tools in areas such as asset allocation, adherence to investment limits, valuation. Those are some of the areas of concern when it comes to mutual funds, and then again we strengthen the supervisory processes. And of course, we've always had a very fantastic surveillance system which we keep renewing as we go along. And that surveillance system is capable of generating alert for various market manipulations, including front running, insider trading, unfair trade practices involving social media and news channels, etc. Let me, move to the. So this is it's a vast area, but in a small amount of time, my idea was just to give you some broad sense of how we are using technology to reshape our market. Now let me move to the key risks which arise out of technology and how SEBI is dealing with those risks. So again, the previous speaker had mentioned cyber is definitely one big risk. Cybersecurity risk is the biggest risk of technology, not just for us, world over. All the regulators are grappling with this. So what we are doing to deal with it is the deployment and use of effective cybersecurity tools across the markets in market infrastructure institutions and also various market intermediaries. That has been it's a clearly an key area of personal priority for us. So apart from cybersecurity incidents, markets can also be impacted by other technical glitches on infrastructure or malfunctions on account of process errors, omissions, inadequate systems, etc. So we have, while these glitches can happen and impact the market for a very short period of time, but the investors may get impacted. What we've done is recently we integrated the exchanges for exchanges because an investor risk reduction access service provide the investors an opportunity acquire or close their open positions and or cancel trading orders in case there is any disruption of trading services provided by the trading company. So in simple English, what it means is if you have problems with your broker which relates to technology, you have an option of going to the exchange platform and then mitigating your issues using that platform. So this is again a unique new initiative. And another very unique initiative that we've taken is in terms of the new framework for business continuity. This has been designed for the interoperable exchanges and housing operators to address the issue of software glitches. This solution would operate as software as a service SaaS model, wherein the unaffected CC billing operation would carry out functions of other affected CC. So we use this SaaS model to deal with the software related. Let me also very briefly talk about the risk from the arising from the unregulated space, where the users are depending on technology and using social media, etc. Let me elaborate that a little bit. So technology has enabled the rise of a number of fintech companies, some of which operate in regulatory gray zones and can pose risk to investors. The risk of unregistered influencers who use social media platforms to provide catchy content and advice on financial topics to their followers is one such example and an area of concerns. While some of the influencers may be genuine educators, there have been a number of cases where these persons are effectively enticing their followers to purchase products, services, or securities in return for undisclosed compensation from platforms or producers. There are huge conflicts of interest potentially. We are examining this issue from a policy perspective. We have issued a consultation paper seeking to restrict the association of civil registered entity to be regulated entity to such unregistered influence from the flow of such compensation. We've also taken enforcement action against a few influencers who were effectively providing unregistered investment advisory services. So, see, the point is, the technology can be a double-edged sword, and some people will try to misuse for their own gains, and regulators have to be alert to identify those potential misuse cases and deal with them both at the policy level and at the. So that was, as far as technology piece from my side. So now let me move to my last piece on how research can support regulatory decision making. So at the outset, let me say that the policy decisions that we take are backed by data and evidence. This would also be in the form of impact studies or backtesting of data. But having said that, I definitely see a lot of scope for enhancing research in the securities market. Effective research can support evidence informed policy making and provide insights on the actual impact of implemented policies. It can also reveal trends and behaviors so that we can stay ahead of the market. Let me give an example. SEBI undertook a study on the loss of individual traders dealing in equity and crypto segment, which showed that 9 out of 10 individual traders incurred losses. This is on the equity FNO. So, as a result of this study, we have introduced the requirement for stockbrokers to permanently display risk disclosures on derivatives to clients on their website. So, that study has helped us in bringing in one step, just to alert the investors. Look, 9 out of 10 people lost the money, and if you want to trade, it is your choice. While my research can make significant contribution to policy making across regulators and standard setters. One specific aspect where I see scope for improvement is organizing research on common policy topics or questions across multiple fields of financial regulation. Most research today is generally conducted in silos. However, there are common areas of interest for policymakers along with interdependencies between different financial. So, what I'm trying to say is, can research in respective financial sector regulators and institutions, can there be a cross fertilization of ideas? Can there be opens for regulators to learn from each other arising out of their research? Just to give you one example, disclosure is a common area of interest for almost all financial regulators. How do we design and communicate disclosures so that they are easily understood and serve the intended purpose? Now, this is one answer which I'm sure all regulators would be interested in. Research on common topics can actually help regulators and policymakers learn from each other. So, what I'm trying to say is that uh, conduct of research across regulators with a more holistic vision would be very, very welcome, and which can actually come from associations like Indian Economic Association. It can help the regulators. In the context, this is my last point. In the context of research, let me also briefly mention two initiatives which we have undertaken. One is the democratization of data. One common challenge of research is the lack of availability of data. To address this issue, we are moving towards democratization of data by making available standardized, structured, and machine-readable data related to every segment of the market. Let me also mention we have safety DRP studies. This has been around for a while, where we invite external researchers. This is development research group studies. We invite external researchers to submit proposals for research in any area of the securities market of their choice. And then SEBI supports the research through assistance in data collection and providing monetary support. Let me pause with that, and I'll not attempt to sort of sum up so what I said. It's such a vast topic, but let me mention that it's a pleasure, and it's a pleasure to share my.
I think there's a technical glitch somewhere. So I must thank Mr. Majid for excellent detailed exposition in such a short time. I'll move on because Shri Rajeshwar Rao is about to join us. So I would now like to move on to Shri Gigi Maman to share with us the journey of financial inclusion covering NABARD and microfinance institution. Mr. Gigi Maman, I want to thank you for accepting our invite at such a short notice. And given the time frame that we have, I would request you to please speak to us for about 10 minutes.
Thank you very much, Dr. Charan Singh sir, and distinguished speakers on this session, and all the eminent economists who are attending this program. I consider myself as privileged to be part of this event, and it's my honor that I have been able to talk to you. I would have loved to be there physically, but because as Dr. Charan Singh said, this decision was almost in the last moment. I couldn't come there, but it's a pleasure to talk to you over online mode. Let me tell you, I have been very fortunate to be part of NABARD almost for 36, 37 years. I was during that my period, I was able to head one of the Government of India's initiative called Mudra, which all of you know that Pradhan Mantri Mudra Yojana, for which NBFC was created called Mudra Limited. I was the CEO of first CEO of that program. I was also fortunate to build one of the microfinance institutions promoted by NABARD. And now, as after my superannuation, I am now heading a association of microfinance institutions called Sanadan. So I have been able to see this financial inclusion from all different sides, from the perspective of a practitioner, from the perspective of the policy maker, from the perspective of a regulator. This has been quite a wonderful journey I had, so I would like to share some of my thoughts on that. As it was mentioned, financial inclusion started way back in 1904 when the first cooperatives were started. That was the first attempt to bring formal banking to the common people. Of course, may not have achieved much results, but it was an initiative started. Subsequent to that, after the independence, we have the nationalization of the Imperial Bank of India, then which became the State Bank of India and its associates. Then we had 1969 nationalization and 1989 nationalization, which Dr. Charan Singh mentioned about. We had also a couple of other initiatives like in 1972, the lead bank scheme was started. Lead bank scheme was nothing but the allocation of funds for different segments, especially for the priority sector segments. So that was an attempt to bring or make available credit to the priority sector needs. Then we had in 1976, we had a new set of banks started called regional rural banks. Regional rural banks was nothing but it was an attempt to make the banking more closer to the regional areas of the rural areas and provide the banking facility to the regional areas and the rural areas. We have 196 regional rural banks at one point of time. Today, of course, it has been many of them got merged, and now we have around 43 regional rural banks in the country. In 1992, one important thing which developed in the financial inclusion was the formation, or as was the launch of SSG Bank Linkage Program. And let me tell you, I take pride to say that NABARD was instrumental in bringing SSG Bank Linkage Program as a financial inclusion program for the people, for the poor people. In fact, microfinance had been taking shape in different parts of the world. We all know, we have all heard about the Bangladesh Grameen Bank, which is a common name everyone talks about. But before that, in 1974, we had something called Seva Bank in Ahmedabad. Seva Bank was an initiative to provide banking services to the unbanked people of the, or unbanked women of the poor women of the Ahmedabad city. That's how a Seva Bank was started. It's a cooperative bank which was having a different type of functioning. In fact, it functioned in a different mode. It functioned in the early morning and the late evenings. So that employees, the women who are having the daily employment can go and do the daily work as also do the transaction in the morning and evening time. That was the concept of Seva Bank. So it was mainly to provide banking services to the poor people, poor women of the Ahmedabad city and to get banking facility. But since it was limited to only Ahmedabad city, it doesn't generally get mentioned when you talk about the microfinance movement. The microfinance movement, when you talk about it, talks about start from the SSG Bank Linkage program in India, that is in 1992. And this also, let me tell you, I was part of the NABARD during that period. It was an experiment, it was an action research experiment was started by NABARD along with one of the NGO in Mysore called Mairada, which was basically a Mysore Resettlement Development Agency, that is the name of that agency. It was mainly working for the resettlement of the Tibetan migrants who came along with the Dalai Lama. So they were settled in and around Mysore, and they were finding it difficult to get financial support. So, and the cooperatives were not able to provide them the kind of financial support. That is when they started something called a credit management group, CMGs, basically to manage their own credit needs. So that's how they started the smaller groups of women, where the women could put in their smaller savings, and that saving was used for further lending to themselves for their immediate requirements. But then that was a very small initiative. So NABARD stepped in then. NABARD was also looking for a opportunity or a initiative to expand this microfinance movement because, as I said, the world over from Bangladesh, Grameen Bank, and also in some of the Latin American countries as well as in African countries, this micro. Are you able to hear me?
Yes, we can. And I would request you to take another 3-4 minutes.
Yeah. I'll just finish it. Another 5 minutes. Give me 5 minutes, please. So that's what I said. The SSG Bank program started as an action research program with Merida, and which got formalized because of the Reserve Bank of India's initiative. Reserve Bank of India came in and, as a revolutionary step, they allowed the SSGs to have bank accounts and do the banking transactions. That is, keep the deposits as well as then also take loan from the banking. So what the SSG Bank Linkage program did was that the groups of women, they were able to mobilize funds from their own little bit savings, which was used for their own internal lending, and then subsequently, once they are matured enough to handle the money by themselves and keep the accounts, they were able to go and get a higher amount from a bank by having the bank linkage program. So they got the money from the bank which got added to their corpus and they were able to get more. So this was something which was a revolutionary step, and RBI was very instrumental in bringing the new policy in 1992, and that is how the new program was launched. In 1995-96, a new set of institutions started coming up in the country called microfinance institutions. Basically, they were basically for lending to the women, to the poor people, for their credit needs, for the smaller credit needs, for the micro credit needs. They were called microfinance institutions. They were also accepted by Reserve Bank of India in 1999, and they said that any institution working for the poor without collaterals, lending to the poor without collateral can be done, access money from the banking institution for such activities. That's how the microfinance institution got, I would say, legitimized. So now today, we have two streams of microfinance system in the country. One is SSG Bank Linkage Program, which has now been taken over by the Government of India, by the Ministry of Rural Development, and they have been named as a national, they have been working under the National Rural Livelihood Mission, NRLM. And it's a big program. This is NABARD started, but now government taken over that program, and it is now a big program. Today, more than 16 crores of women families are part of this. We have more than 1.3 crore SHGs in the country, and around 16 crore families or the households or the women are part of this movement. And the banking system has lent more than 2 lakh crores, 2 trillion rupees. That is outstanding. On the other side, you have another stream called microfinance institutions. Today, we have more than 200 microfinance institutions working in different parts of the country, across the country. And through that microfinance institutions, more than 7 crore households have been given loans. And today, the outstanding as on date is something like 3.9 lakh crores. So together, 3.9 lakh crores plus 2 lakh crores from SSG Bank Linkage Program, almost 6 lakh crores of outstanding is there under the microfinance program. And this is one of the major activity, major development which has happened. When you talk about financial inclusion, we generally talk in terms of opening bank account. Everybody talked about the general bank program, and through which almost 92% of the Indian adults have a bank account today, and more than 2 lakh crores of bank deposit savings are there through these Jan accounts of 50 crore accounts. So that's a big achievement. There's no doubt about 92% of the Indian adult population have a bank account, which is nothing, which is not a small achievement at all. It's a very big achievement. When you say that countries which are underdeveloped have only 8%, 9% of bank accounts or financial inclusion program, we can be proud that we have been able to have almost 100% bank accounts. But that is one part of it. Having a bank account, having a savings account is one part of it. But there are other kind of services are also part of the financial inclusion. And credit is one of the major things. There are credit, insurance, pension, remittance, payment system. These are all part of the financial services which are required under the financial inclusion. But maybe the primary thing is to have a bank. That we have achieved to a great extent. Second one is the credit. Even in the credit, I would say that because of the microfinance activities in the country, as I said, 6 lakh crores of money has been lent by the formal system of microfinance movement. That is a big achievement, and through that, we have been able to support more than 10 crore of household, I would say, because there could be some overlap between the SHG members as well as the JLG members of the microfinance institutions. There are almost 10 crore families have been supported through the microfinance movement. So, hello. Did I just close it? Just close the thing. So, what I was saying is, Sadhan is an association of microfinance institution, and we have been also designated as a self-regulatory organization by the Reserve Bank of India. Yesterday, you must have seen the Reserve Bank of India has come out with an omnibus policy on self-regulatory organization. And let me take pride to say that microfinance institutions have one of the best self-regulatory mechanisms in the country, which Reserve Bank themselves have accepted that. So we are one of the self-regulatory organization, and we have been coordinating the activities of SSG, microfinance in this country, mainly the microfinance institutions. So thank you so much for the patient hearing and giving me this opportunity. Thank you very much.
Thank you very much, Mr. Accommodating our requested such a short notice. We are now moving on to Professor Surendra Kumar from Delhi School.
So, thank you so much. Good morning to everyone, respected chair, colleagues, delegates, and I'm very happy to be with you. And we have listened on financial inclusion as in the beginning opening remarks. Dr. Chan Singh told us that this financial inclusion question is we are following from the very beginning as a part of our development strategy. What I'm going to talk about that we are going so much efforts, but still we can say 2005 about one third of our population was under, we can say, banked population, and even 2014 half of our population was banked. But after that, as Rangarajan committee has recommended in 2008-9, but we started this work in mission mode in 2014. But as a result of that, what are the impacts? And this impact question I'm trying to see in terms of this tax revenue, how our tax revenue is affected by that. Because what we know that as there are more financial inclusion in the economy, as a result of this financial inclusion, there will be higher economic growth. People are banked, people do more economic activities, more formalization of the economy happens, and as a result, people have less scope to evade taxes. More economic activities, more formal activities, more should be the tax revenue in that. So that's why means along with this national level, I'm using more information at the state level for this period of we can say around 15 years, 2004 to 19, and then we are trying to understand this causal relationship between these indicators of the financial inclusion and we can say the tax revenue, all direct, indirect, everything in that way. Okay, and here the approach that we are following is a novel approach in this sense because we have to establish the causal relationship, and here we are following the structural break approach because here once the person is have adopted this kind of framework, the person is not going to back. So this conventional causal relationship estimates that may not be relevant in this case. So that's why we are using it. And here we are following this just four indicators. Two of we can say the financial inclusion and two of the financial development. In the financial inclusions means these deposit accounts and credit accounts per thousand of the population, and on the other side in the financial development we are using these indicators of we can say this deposit GDP ratio or credit GDP ratios. Okay, just to have a look on these figures, this first figure is showing about these deposit accounts, and here you may see that around you can say this both deposit and credit accounts, you will see that there is some kind of change or some kind of kink around you can say this mid 2010, that period, some kind of okay, and as a result even in absolute terms this account means this deposit and credits, they have increased in an exponential way. That's happening. But when we try to see at these financial development indicators, this GDP, deposit GDP ratio or credit GDP ratios, there the picture is not so clear. But that's why it becomes question whether these policies are benefiting in terms of tax revenue or not. Okay, to have more idea about it, this financial inclusion and economic growth, how it's happening. So here we can say it's well understood that there is a positive relationship because of this more economic activities are expected, and that's why we are doing all these efforts. So whatever indicators we use, so all in that you will find there is positive relationship, and even we can say these relationships, they are not linear, even you can say the exponential relationship in these lower diagrams in that. Okay, so that's the one side of the picture. On the other side, you may see that in this first part, how this corporate tax or personal income tax, how they are moving. And here again, you will find that around 2008-9, there is a kink. And then again, you will observe in this figure, there is kink. These are the absolute data just plotted in that, but in absolute data also at these 2 points there are kings in mid 2010s, and you can say before 2010s, the 7 8, that kind of period. Okay, similarly kind of trend you may observe in this direct and indirect taxes together if we take. And here also in this lower part you may observe that this tax returns, filing of tax returns, that's also substantially increased if we try to relate these periods of the financial inclusion when we started in emission mode. But this relationship, when we put in terms of this deposit and tax revenue ratios, there is positive relationship, but that's not so strong kind of relationship. That's why it becomes the questions to go in more in depth and try to understand whether these kind of policies are really giving us an advantage or not. Okay, so that's why I had said that to distinguish this impact of the big push initiatives. These are not simple incremental changes we started into, you can say this 2014 or 15, but these are big push kind of initiatives. And due to this big push initiative of the financial inclusions, how tax receipts are affected for that, we are following this panel structural break approach, because this structural panel break approach, given the context of our country, a developing country where substantial changes are happening, though the policies are there for the long terms. So in that situations, and secondly what we know that these kind of methods, they are more robust in comparison to the standard causal approaches like DID, difference in difference estimators, because there we have to take certain assumptions which are not required, like you can say these parallel trend assumptions. So in that way we can say this approach is more robust, and here we can find a particular point of break as well as the confidence interval related to that. Then given those breaks, then the question is, of course there is break if we say, but whether this relationship has strengthened after break period or no. For to understand that, we are using, we can say, this GMM kind of dynamic panel approaches in that case. And here this is simple, you can say the descriptive statics, and here you can say that all these statics, because these are the time series, panel time series, and none of them is, you can say, satisfying the stationarity conditions. So that's why we have to be careful in that. And also there is this cross sectional dependency in the data. So that's why this approach we need to take accordingly, otherwise we can say spurious kind of relations. Okay, so again we can say this financial inclusion and economic growth. And here you will observe in this figure that most of these observations, they are clustered in a particular regions. So we can say there are some of the states which we can say the outliers, and that's why the question becomes the relationship whether driven by these outliers or is it a structural kind of relationship. Okay, all these with respect to tax revenue also there is clusters, growth with respect to clusters, that we find in that. Okay, so given all these kind, let's comes to the result part. And here, as far as this tax revenue GDP ratio, credit GDP ratio, these relationships, there we find that these break points, they are at 2 points in this 15-year period. One is in 2009 as deposit is concerned, and as credit is concerned it's 2010. That is the first break. And it may, the reason, because in 28 this financial crisis was there. So as a result of this financial crisis, people may be withdrawing their money from these financial markets, the stock markets, and they may be going to the banks. So that may be the reasoning behind that. Similarly, because of this financial crisis, then the government started this liberalized lending. So that's why in the credit also in the 2010 this break may be that reason for that. But in deposit, and credit, there we find as these ratios are concerned, there is the break in 2015 and 2016. And this we may attribute to these policies which we started in the mission mode. Either you say in the credit front, we have this Mudra scheme, which was basically we can say funding the unfunds, and deposit scheme was bank means bank the unbanked, that kind of schemes. But these relationships are very clear about these deposit accounts and credit accounts. In 2014 there is break, as Chan Singh in the beginning said that in this particular year 2014 we were able to open more than a crore accounts, deposit accounts. And when these deposit accounts are opened, so it's not that they remain just these deposit questions, because simple in this money creation process as undergraduate level also we study, they also create the credit accounts. So though this Mudra scheme was started in 2015, but the break in the credit accounts, that's start, we can say it's somewhere in 2014 itself, because both this deposit and credits they are interlinked in that. And there is this confidence interval also we observe that that's not too far, means the results are more precise in that way. And all that's also implied by, you can say, this superworld test, all they are highly significant in that. So given that kind of situations, even in the figure, you may observe where is the break on those points. This relationship means we can say that due to starting these schemes in the mission mode, as a result, we are benefited in terms of the tax revenues. And that we can say one of the explanations, as in recent year people raise this question that we are observing this higher growth in the tax revenues, what are the immediate reasons, along with we can say these enforcement measures. But here, because we have able to bank the unbanked and fund the unfunded, so as a result this formalization of the economy is happening, this tax evasion we are able to reduce. So that's why this kind of situation we can observe. And this I just avoiding these results. So here in this table, just one thing you have to observe, means of course there is a positive relationship, but this positive relationship after break period, it's strengthening. It's not just in continuity, but it's strengthening. And that gives us the confidence that when we start these kind of policies in a mission mode, so as a result of this mission mode, there are, we can say, substantial economic growth, means our objectives of the economy we can achieve given the size of the economy. Here this incremental kind of changes cannot work. So that's why to have this, we can see the policy at a mission mode, they will be more beneficial. So just I conclude that, so we are able to show that because we started in the mission mode, this mission mode framework is more result oriented, but still we have some population which is outside this. So that's why we need to not just to continue with these policies, we need to find the way how we can strengthen those things. And I stop it. Thank you so much.
Yeah. Good morning. Good morning. Am I audible? Yes, you are. So let me start the next most important session that we have, the P.R. Brahmananda Memorial Lecture. Professor P.R. Brahmananda, an eminent economist of our country, who had worked for nearly 5 decades and in those 5 decades published 36 books and more than 700 papers and articles. Professor Brahmananda was also on the art and is most well known amongst all of us. In the ranking of the 17th economy, the Reserve Bank of India had also instituted the RB Memorial Lecture, under which many lectures were delivered. In the Indian Economic Association, to deliver this most important P.R. Brahmananda Memorial Lecture, we have invited the Deputy Governor from the Reserve Bank of India, Mr. M. Rajeshwar Rao. Mr. M. Rajeshwar Rao, an eminent RBI official, was elevated to the position of Executive Director in 2016. He has worked in various departments of the Reserve Bank of India. In recognition of his work, he was elevated to the position of the Deputy Governor in October 2020 for a 3-year term. In continuation of the excellent work that Mr. Rao was delivering, he was given an extension by the government in October 2023. We are very privileged and honored to have Mr. Rao with us to deliver this special P.R. Brahmananda Memorial Lecture. Sir, just to bring into the picture, I would like to mention that since morning we have been talking about financial inclusion. We have had speakers from SEBI, NABARD, and Professor Surendra Kumar from Delhi School of Economics speak to us. Yesterday, we had spent the whole day on various aspects of the economy. We had discussed about multidimensional poverty. We had discussed about data analysis, artificial intelligence, and research for development. And we had a session totally dedicated 2 hours on aspirational India, the Prime Minister's thought of India at 2047. The conference had been inaugurated by Vice Chairman Niti Aayog, Shri Suman Bed. We would like to invite you to share your thoughts with us. Mr. Rao, please.
Thank you, Dr. Charan Singh. A very good morning to all the distinguished participants of the conference organized by the Indian Economic Association. Good morning, warm welcome. Thank you very much for inviting me to give this talk and also share a few thoughts on this very pertinent theme of finance, financial inclusion, finance, banking, and technology. The theme of my talk, I thought, would be on innovations in banking and the emerging role for technology and artificial intelligence. I would like to focus largely on the RBI's efforts to foster innovation in the financial ecosystem and how the emerging technologies such as artificial intelligence are likely to reshape the financial landscape. The banks have played an extremely important role in supporting the growth story of the Indian economy. If we were to analyze the evolution of the Indian banking sector over the last 5 decades or so, we can classify this evolution into 3 distinct phases. First is the post-nationalization phase, the second is the liberalization of the 90s, and the third and current phase, which, for lack of an appropriate alternative, I would call it as democratization of credit and inclusion. The level of financial intermediation at the time of independence was quite low in India. It ranged below 20% of the GDP at this point in time. This was more or less the case over the next 2 decades or so. With limited financialization and outreach of banking services, the scope to mobilize deposits, facilitate credit flow, and support the aspirations of a developing country was constrained. But this trend changed with the nationalization of the banks, which ensured a wider banking reach. This led to the opening of bank branches across the country, resulting in greater mobilization of deposits and growth in credit, primarily for catering to the credit needs of the priority sectors. The second distinctive phase in the evolution of banking sector was observed during the post-liberalization phase from 1991 till about 2003 to 4. During this period, the financial intermediation was fundamentally transformed as globalization and integration opened up various growth opportunities, leading to increase in demand for credit. Also, in tune with the spirit of economic reforms, private entities were allowed to enter the banking sector and they supplemented the collective endeavor of the banking industry to support the growth story. Economic growth, aided by institutional and other attendant reforms, along with greater technological adoption in the banking sector, spurred a robust growth in both deposits and credit during this period. While the first two events, namely nationalization and the liberalization, are definitive in nature in the sense that we can attribute definite timestamps for these events, the third phase of democratizing of banking services, which we are currently experiencing, is continuing as a gradual but transformative process where the pace has accelerated over the last few years. This democratization phase has coagulated of late, underpinned by the trinity of financial inclusion, increase in financial literacy, and focus on consumer protection. This phase has also witnessed a massive expansion of the banking outreach, especially amongst the hitherto excluded sections, through innovative delivery models such as the use of banking correspondence. This democratization of financial services got a major push through the Pradhan Mantri Jan Dhan Yojana and the direct benefit transfer scheme, along with the proliferation of mobile and telecom services. I would not be off the mark when I say that this phase has been a perfect combination of demand pull and supply push models working in tandem. Today, we are witnessing the unfolding of true democratization of financial services, where the customers are greatly enabled to make informed choices among a suite of financial products, banks, and provided by the banks and other financial service providers. While we are discussing the role of banks in the India's economic journey, let's not lose sight of the contribution and the increasing importance of other financial intermediaries. Although bank credit remains the dominant mode for meeting the growing credit needs of the commercial and household sectors, the share of non-banking financial companies, the microfinancial institutions, and of late, market instruments has also been increasing. Non-banks, through their innovative delivery and appraisal methods, have expanded the credit to the geographical length and breadth of the country. They have, along with the banks, contributed immensely to this journey of democratization of financial services. India has transitioned from being a third world economy to the fifth largest economy today. We are also poised to become the third largest economy over the next few years and have the aspiration of becoming a developed nation by 2047. Reserve Bank too has played a crucial role in unfolding of this growth story. We are one of the very few central banks around the world which have been entrusted with a developmental mandate along with traditional central banking functions. For the development of our financial architecture, support the aspirational growth of the country, the Reserve Bank is transitioning to become a leader in saving new frontiers in creating world-class financial infrastructure. Let me cite a few examples. Today, India has one of the most advanced state-of-the-art payment systems that is affordable, accessible, convenient, fast, safe, and secure. Our payment infrastructure caters to the needs of a diverse group of consumers and offers a wide array of options for executing all types of transactions. This has led to a revolution in the banking and financial services, making banking truly anytime, anywhere. Everyone is aware of the success of the UPI and the convenience it offers. UPI, the United Payment Interface, symbolizes the ultimate democratization of financial product which is available to everyone, including to the customers who may not have a smartphone, as well as for undertaking offline transactions. To put things in perspective, during the financial year 22-23, UPI facilitated about 83 billion transactions with an approximate value of rupees 140 trillion. This is roughly 43% of the total value of the retail payment transactions. Another technological initiative where the Reserve Bank has emerged as a leader is the central bank digital currency. We were one of the first major economies to launch the CBDC when we launched the pilot phases of wholesale and retail CBDC in October and November 22 respectively. Apart from its own initiatives, Reserve Bank has facilitated technological innovation in banking, non-banking, payment services, or financial markets. With its commitment to technology-led innovations, the Reserve Bank has set up the Reserve Bank of India Innovation Hub to accelerate innovations across the spectrum of financial services. In addition, the RBI has also instituted a regulatory sandbox to provide a platform for startups, fintechs, and other entities to test and experiment with new products in a controlled environment. Discussions about emerging technologies offers an opportunity to dwell a bit on how the financial industry would need to interact with newer technologies and the breakthroughs in areas such as artificial intelligence. At different points in time, there have been breakthroughs which have redefined the future evolution of human societies, such as the invention of the wheel, the steam engine, the development of vaccines, the computer, and more recently, the internet and mobile phones. The emergence of artificial intelligence, or AI as it's commonly known, is also being cited as being in the same league, and the proponents of AI sound convinced that it is going to transform the future. I'm no expert on technology, and my focus is limited to understanding its implications for economic growth and the financial sector. Therefore, let me share a few thoughts on the adoption of AI by banking and financial service sector and the risks and rewards that this may entail. As I understand, the AI models can be placed into two categories. The first set is the traditional AI models, while the second is categorized as generative AI or the Gen AI. The differentiation between the two is based on their capabilities and applications. Most of the AI models currently available are in the form of traditional AI and have been designed to perform a particular task or a set of tasks by responding to a set of inputs or insights. Traditional AI models can also learn and identify patterns from the available data set and can make predictions based on the available data. However, they can only respond within the predefined boundaries and follow specific preset rules. The development of Gen AI, a type of AI technology that can produce various types of content, including text, imagery, audio, and synthetic data, has garnered a very strong interest about its potential economic impact. ChatGPT, which is a popular AI tool, tells us that Gen AI possesses general intelligence and cognitive abilities comparable to those of a human being. It is not confined to a specific set of tasks, but can adapt and learn in various domains, demonstrating a level of autonomy, reasoning, and problem solving capabilities often similar to human intelligence. Current estimates on the AI's boost to productivity and economic growth are substantial but highly uncertain. Academic research suggests that workers in early AI adopting firms experience higher labor productivity growth. Most estimates imply around 2 to 3 percentage point increase per year. One estimate by Goldman Sachs suggests that the generative AI could, other things being equal, boost global GDP by about 7 percentage points over a 10-year period. In the financial sector, we are seeing several banks and non-banks experimenting with AI. However, the global experience suggests that such deployment is mostly limited to back office jobs and optimization of business processes to deliver efficiency gains. Some of the banks have also deployed AI solutions to manage compliance requirements which are routine in nature, for identification of patterns in transactions or payment to detect money laundering attempts or for facilitating cross-border transactions and settlements. Some entities are also reported to deploy AI solutions in the customer-facing processes, such as making lending decisions or identification of target customer segments. Given its transformative nature and potential, if realized, generative AI could have deep impact on productivity, jobs, and income distribution. The advocates of AI expect widespread benefits for the economy and society, including increase in income levels, automation of repetitive tasks, and obtain better insights by combining different sets of information and data, which can be otherwise difficult for human processing. There are others who are more skeptical and point to several societal consequences, including increasing unemployment. They also point out that if long-term benefits are largely benign, the reallocation of resources and labor in the transition could be painful. We have also seen that these concerns are being expressed in India with reference to the IT sector. But the debate is ongoing and is unlikely to be settled in the near future. Let me, however, flag a few concerns and also elucidate our expectations from the financial institutions deploying AI into business processes and decision making. While some of these concerns are design-specific risks, such as biases and robustness issues, others are more traditional and user-specific, such as data privacy, cybersecurity, consumer protection, and preservation of financial stability. These issues could be placed into three broad categories: data bias and robustness, governance, and transparency. AI is as good as the data on which it has been trained and thus inherits the issues, biases, and errors in its training data. Human beings accumulate such training data over a lifetime of exposures, experiences, evidences, and upbringing. That makes us capable of coming to different conclusions based on the same data set. Further, humans can collaborate, combine, and brainstorm to reach an optimal solution. This is not to say that humans are free from biases, but we have embedded checks and balances in the institutional decision making frameworks to check and prevent. Whereas traditional financial models are usually rule based with explicit fixed parameterization, AI models drastically change the process as they are able to learn the rules and alter model parameterization iteratively. This aspect makes many artificial intelligence models a black box, which are difficult to decode or audit and supervisory review. Besides, there are several risks and vulnerabilities such as arbitrary code execution, things like data poisoning, data drift, and unexpected behavior, as well as bias, which the financial institutions need to be careful about while deploying the AI models. AI may also pose challenges for government, especially where the technology is used to facilitate autonomous decision making and may limit or even potentially eliminate human judgment and oversight. Some of the data and model issues, such as we use the term prompt injection, hallucination, and toxic output, it can have implications for governance frameworks, especially in financial institutions. This may necessitate regulators and managements having to relook at the frameworks for consumer protection, cybersecurity, and address data privacy. Some suggestions have been made to overcome governance issues, including the option of putting a human in the loop to help build trust in the artificial intelligence driven system. Financial institutions would therefore need to institute governance structure that can oversee the entire life cycle of the AI system, especially the Gen AI, from data acquisition to model training and continuous evaluation. Regular audits and assessments would also be essential to verify the fairness, accountability, and compliance of artificial intelligence applications to the extent laws and regulatory standards. The AI models are also inherently complex and opaque, therefore requiring extra caution to ensure accountability. For this reason, the financial institutions may not be able to explain an adverse or a biased decision outcome from an AI model to customers or to the supervisors. The self-learning capability may make the model discriminatory and induce behavioral biases after some time. For example, An algorithm may predict gender or potential target customer from shopping history of a person or ethnicity from a location data. The laws may often prevent discrimination, but how do institutions overcome these challenges in a transparent manner is a key to the widespread adoption and use of artificial intelligence. In this context, about 10 aspects which financial institutions looking to deploy the AI-based model should consider while designing the AI solutions in order to strike a balance between innovation and responsible use of technology to ensure fairness, prevent bias, and safeguard consumer privacy. These aspects start with fairness. It should be ensured that algorithm does not discriminate positively or negatively against anyone based on attributes which are otherwise considered unethical or prohibited by law. This can be achieved by conducting a regular fairness audit of the algorithm and outcomes, including external validation, and by employing techniques to identify and rectify any unintended bias. The second issue aspect is transparency. All stakeholders should be aware of what are the inputs and how the decision making is being arrived at. This by making the algorithmic decision making process understandable and explainable to both regulators and to the consumers. The third aspect is accuracy. The entities deploying the AI should strive for accurate and appropriate training data to minimize errors in decision making, identifying and understanding the type of errors the AI model makes, and also continuously work to minimize the false positives and negatives. The fourth dimension is consistency. The entity should ensure consistent application of algorithm across different situations to avoid bias or unfair advantages and also ensure equitable outcomes. Parameters entering the models also need to be consistent and too frequent changes to meet specific interests should not be permitted. The fifth is data privacy. In today's digitized world, adhering to data protection regulations and ensuring that personal information is handled securely and responsibly is of utmost importance. Therefore, the AI models should be designed to adhere to data protection protocols and regulations, and entities should ensure that the personal information is always handled securely and responsibly. The sixth is explainability. The entities should be able to provide clear explanation for the factors influencing decision or the output to enhance transparency and build trust in the models. Clear understanding of inputs, understanding of the processes and output by the entity, and establishing channels for redressal of customer queries or disputes will help in promoting this trust. The seventh is accountability. Clear lines of accountability for the outcomes of algorithmic decisions should be ensured to make it clear that who is responsible for the performance, robustness, and fairness of the model. Entities should implement a comprehensive governance framework which includes regular audits, internal reviews, and external assessments to hold individuals responsible for addressing any issues relating to the model. The eighth is robustness. The entities must undertake rigorous validation and testing to ensure that the algorithm performs well under different conditions and is not overly sensitive to minor changes in the data inputs. Regularly updating the model's training data to include a broad spectrum of conditions, ensuring adaptability to changes in the economic landscape, and maintaining robust performance over time is critical. Ninth is monitoring and updating, regular monitoring the performance and updating it as may be required to adapt to changing market conditions will have to be ensured. Also, monitoring the evolution in case of self-learning algorithms is critical to ensure that they continue to perform as envisaged originally. Finally, of course, the dimension of human oversight. The entity should include human oversight to address complex and ambiguous cases and to ensure ethical considerations are taken into account. This would also ensure that any unintended consequence of the governance issues would be detected in a timely manner and redressed appropriately. I think incorporating these 10 dimensions would help in developing the trust of the public if we truly want to exploit the transformative potential of AI. Let me also point out that in addition to institution specific challenges, there are several geopolitical and systemic issues which would also engage us going forward. For example, like in any other technological development of the past, the access to technology is going to be uneven among the countries. Advanced economies may stand to benefit more from than the emerging market economies due to the fact that the EMEs have a higher share of employment in sectors such as agriculture and construction, which would inherently have less opportunities for application of AI. Further, due to constrained resources, EMEs may face difficulty in adopting to AI, affecting their relative productivity and global competitiveness. In addition to above, there are only a handful of entities globally who have a large amount of data available to train the Gen AI models. This could give rise to questions of market power, competition, and cross-jurisdictional issues. To conclude, let me say that as our banking sector evolves, emerging technologies and AI will play a very significant role in the process. We have to ensure that a supportive regulatory framework exists to harness its benefits while being mindful of any potential adverse impacts, and robust governance elements and clear accountability frameworks are important where AI models are deployed in high value decision making cases. Development and deployment of AI models needs close human supervision commensurate with the risks that could materialize from employing the technology by the financial institutions. As adoption of AI is increasing, global efforts to develop regulatory frameworks to help guide AI application is also increasing, and greater cooperation in this process would be required. Our collective endeavor should be to embrace this evolution with a mindfulness and a sense of responsibility while committing to a future where technology serves as an enabler for the society at large. I will stop with that. Thank you very much for your patience. Thank you.
Mr. Rao, I must thank you for such a detailed discussion on application of technology in the banking sector. Listening to your speech, we as economists here do feel, and I'm sure once the speech is in public domain, that the amount of labor and effort that the Reserve Bank, the regulator, is making in ensuring safe and secure banking is certainly going to be trustworthy. As you would appreciate, given the level of financial literacy, at certain levels, there's always a fear that my accounts and the hard-earned money can be misused or misplaced. The fact that you have gone in detail in sharing various aspects that one can conceive and think, which could be potential vulnerable areas, simply gives us trust and faith that the regulator is in total command of what is being developed. The sandbox, which the RBI had proposed, is an excellent idea, an experiment which is considered or which can be conducted under controlled conditions. The 10 points that you have mentioned, which also include human oversight, as well as the geopolitical issues that you have mentioned, literally show that the Reserve Bank, the regulator, is totally in command of this transition. I must thank you for your detailed presentation with us at this Indian Economic Association. I know you're hard pressed on time, but I was still selfish and wondering, would you like to take a question or two?
Maybe perhaps a couple of questions at this. I think we have about 5-10 minutes.
So I think we are very privileged that the Deputy Governor is willing and accepting to take questions. So we have, I'll open the house for questions. Yes, so let me go in this. Please give the mic here. So we'll only take 2 questions, as he mentioned, is just about 5 minutes. And I know he had an appointment at 12 noon, but he's just kind to us. Yeah, your mic, please.
Thank you, sir. My question is how we can check data dumping as well as data monitoring. Thank you.
Well,
Data dump and second part I didn't get it.
data monitoring.
Monitoring.
I'll take three questions and then I'll leave it to you to answer. Yeah, the second question, please.
Thank you, Deputy Governor. Would you kindly throw some light on the innovations that RBI has done in the area of green finance? We have been speaking on that. I have been keeping track of that. But can you throw more light on that?
So this question is on green finance, innovations in green finance. And the last question up here. No, we'll give you the mic because for him to listen will be a challenge.
Very good morning, sir. Thank you very much for your wonderful words. So my question is this, that you have just mentioned that we have started the offline transaction facility. So for the same, do we need to come back in the connectivity where there is that? And do we have a advance redressal committee for the same? Because suppose there are 10 to 20 transactions are in a day in that particular remote areas where the connectivity is lost. So do we have something for the same? Thank you.
I think three
Okay,
questions.
yeah.
We'll leave it to the Deputy Governor now, given his
Okay,
time.
thank you. Thank you very much for the three questions. I think, of course, see this data dump and monitoring, if I understood the question, are you linking it to the AI aspect or is it a general question? Because
He is linking up with the AI question.
no, in fact, I think this data dump and monitoring is going to be crucial because, see, in an AI environment where the model starts self-learning based on the data inputs, the quality of the data and what is being fed in is going to be even more important. As I highlighted, with this self-generating or self-learning ability, the chances of biases being developed in the model to supplement or maybe actually aggravate the already possible biases which are built into the system by the model creator is going to be that much more challenging or something which we will have to address down the way. Let us say a credit appraisal data is being, a credit model is being generated to look at sanctioning of credit. So if the data quality and the inherent bias in the model generated by the program aggravates the situation, there could be situations where a lot of financial exclusion could happen by default. Because if you depend on the model at that point in time, the default options could be built in because the model reinforces its what do you call it, pre-programmed biases into the system, and maybe the data quality also supplements that, and the chances of data exclusion could be there. So I think quality of data, quality of monitoring of the data which is going into the model, along with the rigorous oversight of the model, will have to be put in place if we want to harness the benefits of the Gen AI techniques, especially in the areas of banking or delivery of financial services. That is one aspect. Second aspect, as far as the green finance is concerned, I think that is going to be a critical challenge, maybe less from the AI perspective, but a general banking challenge as far as we are concerned. With the impact of climate change on the banking books, I think we have to increasingly recognize it's going to change the way the, what do you call, bank will have to look at risks because the climate events can impact their portfolios quite significantly, could be localized. So we have put in place guidelines for the banks to how to look at the risks in the portfolio. We are also coming out with some guidance on how to stress test the portfolio. Maybe we need to some kind of other guidelines to for disclosures of the risks on the bank's portfolio. That is one dimension. So I think green finance is still a nascent area, but I think we need more work and more commitments from the institutions to address this issue going forward because it's going to be a critical challenge for us in the country. Now, as far as the offline transactions are concerned, I think the grievance redressal mechanism which we already have in place should be sufficient to address the issue. In the sense, we have the internal the grievance redressal within the RBI framework consists of the ombudsman, where we have an internal ombudsman who looks at the grievance first. If the customer concerned is not happy with the decision taken by that ombudsman, he has a right to appeal to the RBI ombudsman, and then based on the facts of the case, some kind of judgments could come from the ombudsman. Of course, this is only to supplement the consumer redressal framework which is already existing under the Consumer Protection Act. So this would be one mechanism. It should be applicable even for offline or other transactions. And then many of the cases in debit transactions, if there are unauthorized debits, because that's something which could be a serious challenge which can happen in today's scenario with the vulnerability to cyber security threats. I think there is an option that you can immediately file a rebuttal and provide documentary evidence. The banks will have to investigate and make good the money almost immediately. So I think there is already a mechanism which is in place to address challenges of digital payments or what do you call it, failure of digital payments or etc. So I think existing grievance redressal mechanism would take care of these challenges.
As a session chair, I would like to thank you for your time. The conference president would now propose the vote of thanks to the deputy governor.
Thank you, Professor Singh.
I'm thankful to Shri Rajeshwar Rao for sparing us time. We know we requested almost every expert at a very short notice, but the way, in fact, he has presented his view on AI use of technology in Indian banking in particular and financial sector overall, I think it has enlightened all of us, and it did provoke the audience also that they had few questions posed before you. There were a number of questions, in fact. Maybe we would get better connected in days to come. I would just say thank you a lot. I know that your office also kept us little on alert also, but I could definitely come to negotiate with that and we could have you among us this morning just for the information of yours, because Professor Singh in the morning itself briefed us that who all are going to participate and who all have participated so far as resource persons. In the evening, for the information of the audience, we are going to have another very interesting address from none other than Professor Krishnamurthy Subramaniam from USA. Right, it's at 6:30. I request you all to remain here and, of course, give him a warm welcome and audience. Thank you, Shri Rao. Thank you.
Okay, thank you everybody.
Thank you, sir. As we come to the conclusion of this session, I would request Professor V.K. Malhotra, sir, to please felicitate Professor Surendra Kumar, sir. Sir. Thank you everyone for patiently listening us. Now we'll be breaking for tea and I request you all to be back here by 12:10. Positively. Thank you.